Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of understanding the VIX, what the Volatility Index means for investors in 2024. Pairing with S&P 500 positions. The VIX is inversely correlated with the S&P 500 market movements. Savvy traders sometimes combine positions in S&P 500 ETFs with VIX futures or options to balance out risks. For example, a long equity position can be paired with a VIX hedge to protect against sudden downturns. Using VIX ETFs or ETNs. Exchange-traded products tied to VIX futures are great for those looking for simplicity. These funds are designed to track the overall volatility trend, giving you exposure without requiring direct futures or options trading. Remember, trading the VIX isn't without risks. Its price movement can be unpredictable, and instruments like futures and options come with inherent complexity. Always have a clear plan and stick to it. Whether you're hedging or speculating, staying informed will sharpen your edge. By understanding these tools and strategies, you can explore opportunities in volatile markets while managing risk effectively. Limitations of the VIX. While the VIX is a powerful tool for understanding market volatility, it comes with its own set of limitations. Misinterpretations and external factors can distort its usefulness if you don't fully grasp how it works. Let's uncover what you need to watch out for. Misinterpretations of VIX data. Many investors misunderstand the VIX, which can lead to incorrect conclusions or poor decisions. Here are some common misconceptions. The VIX predicts market direction. One of the biggest myths is that a rising VIX means the stock market will crash. However, the VIX doesn't tell you whether the market is going up or down, only how erratic prices might get. A high VIX signals uncertainty, not a guaranteed sell-off. It's an all-in-one indicator. The VIX is just one piece of the puzzle. Some think it's a standalone measure of market health, but it's not. It doesn't account for economic fundamentals, geopolitical risks, or policy changes. The VIX is always accurate. Sometimes the implied volatility reflected in the VIX doesn't match actual market behavior. For example, the market may stay calm even with a high VIX reading, or vice versa. A low VIX means the market is safe. A calm market might seem like good news, but low volatility can also signal complacency. This can create blind spots for sudden, unexpected events. Understanding what the VIX shows, and just as importantly, what it doesn't, is essential for accurate analysis. Don't rely on it as your sole guide. Market conditions and VIX performance. How the VIX behaves depends heavily on market conditions. It doesn't exist in a vacuum, and its readings can be influenced by external factors. Here's how market environments can affect its performance. Stable markets. During periods of steady growth, the VIX often remains low. This doesn't mean markets are risk-free. Low VIX values can sometimes lead to overconfidence, increasing the chance of sharp corrections when volatility returns. Sudden market events. Unexpected events like geopolitical tensions or economic data releases can cause the VIX to spike. However, these spikes are often short-lived, as markets quickly digest the news. Extended volatility. In prolonged market sell-offs or financial crises, the VIX can stay elevated for longer periods. This creates challenges for using it as a predictive tool since uncertainty persists, and emotions drive market behavior. Low trading volume. When fewer traders are active, such as during holidays or quiet summer months, the VIX may give misleading signals. Smaller volumes can amplify price movements, making the market appear more volatile than it actually is. Impact of external catalysts. Central bank policies, earnings reports, or even regulatory changes can skew how the VIX behaves. For example, a Federal Reserve announcement might create temporary volatility, but it doesn't always reflect broader market trends. The VIX works best as a snapshot of sentiment under typical conditions. However, it's less effective during anomalies or when external disruptions skew the data. Always consider the bigger picture when interpreting its readings. By keeping these limitations in mind, you can use the VIX more effectively as part of your decision-making toolkit. VIX in historical context. The VIX has become a key tool for tracking market fears, but its behavior isn't random. By looking at its historical performance, we can better understand how it reacts to major events and long-term trends. This context is essential for seeing how volatility has shaped market outcomes. VIX during financial crises. During times of financial chaos, the VIX often skyrockets. It reflects investors' panic and uncertainty as markets face sudden disruptions. Let's take a closer look at some notable moments. 2008 financial crisis. The VIX hit an all-time high of 89.53 in October 2008. This was during the peak of the global financial meltdown, driven by the collapse of Lehman Brothers and fears of systemic banking failures. The extreme reading gave a clear signal of widespread market anxiety. COVID-19 market crash, March 2020. The pandemic sent shockwaves through global financial markets. The VIX surged to 82.69 on March 16, 2020, its second highest level ever. Investors scrambled as lockdowns triggered widespread economic uncertainty, disrupting industries across the board. Dot-com bubble burst, 2002. As tech stocks collapsed, the VIX reflected growing anxiety, peaking above 40 multiple times. While these levels weren't as extreme as in 2008 or 2020, it showed the struggles of overvalued markets trying to reset. European debt crisis, 2011. Rising fears about Greece's debt and a potential Eurozone breakup pushed the VIX near 48 in August 2011. This came as global markets faced concerns about government solvency and economic growth. Every crisis brings its own drivers, but the pattern is clear. When fear strikes, the VIX reacts. By studying its behavior during these events, we see how market sentiment turns on a dime during uncertainty. VIX trends and patterns. The VIX doesn't just spike in crises, it also follows long-term trends and seasonal patterns. Understanding these can help investors anticipate movements more effectively. Mean reversion. The VIX has a reputation for snapping back to its historical average. Its long-term mean hovers around 1920. Whenever it spikes significantly, it typically declines back to this range within weeks or months. Think of it like a rubber band. Stretch it far, and it's bound to snap back. Periods of prolonged calm. Extended periods of low volatility happen during stable economic growth. Between 2013 and 2017, the VIX consistently stayed below 15 as markets climbed steadily. However, low levels may signal complacency. A sudden shock can jolt the market when investors least expect it. Seasonal patterns. The VIX often rises during specific periods like September and October, months historically tied to stock market weakness. On the flip side, summer months tend to see lower VIX readings due to lighter trading volumes and fewer market-moving events. Inverse correlation with S&P 500. When stocks fall, the VIX usually rises. This inverse relationship comes from fear-driven hedging activity in the options market. During rallies, the VIX tends to drop as confidence grows. Unprecedented volatility in extraordinary times. Certain events break the mold. For example, the 2020 pandemic saw sustained high readings for weeks, as uncertainty dragged on longer than most crises. Such anomalies remind us that the VIX isn't always predictable. By observing these trends, traders can better understand the VIX's rhythms. It may not be a crystal ball, but it's a valuable compass for navigating market volatility. Understanding its historical context helps you prepare for future surprises, without being blindsided by the unexpected. Conclusion. Key takeaways on the VIX. The Volatility Index, VIX, is like a market weather forecast. It tells you how turbulent things might get. By now, you should understand that the VIX doesn't predict market direction. It gauges how erratic movements could be over the next month. Recognizing the VIX's behavior during financial panic, reading the mood of the market, and factoring in its limitations can help you make smarter portfolio decisions. It's not the only tool you need, but it's a powerful one to have in your toolkit when uncertainty looms. When volatility spikes, it's like watching storm clouds gather over the market. The key is knowing how to prepare without overreacting. Got the tools and strategies lined up? Then you'll know when to batten down the hatches or let the calm weather work in your favor. Stay sharp, keep analyzing trends, and use the VIX to guide, not dictate, your decisions in the ever-changing market environment. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.